in the past 1 or 2 months, we witnessed the market really fall. Could you please share the key factors behind the same?
If you look at equity markets, volatility is part of equity markets. Now, on the external side, you've had geopolitical tension, you've had uncertainty about monetary policy, especially where the Fed is concerned. Government spending was absent in the first half. Look at stocks where valuations are reasonable as compared to stocks where valuations are rich. We are starting to see signs of discretionary tech spend come back in large verticals such as
Indian benchmarks remain volatile in the month gone by. But what's in store for December? Let's discuss this with Shibani Kurian, Fund Manager and Head Equity Research, Kotak Mahindra Asset Management Company Limited. Thank you, Shibani, for joining us today. So the first question is that in the past 1 or 2 months, we witnessed the market really fall. Could you please share the key factors behind the same?
So, hi. Obviously, if you look at equity markets, volatility is part of equity markets. We've had 3 great years, and therefore last couple of months we've seen some degree of volatility. Now, when you look at what's happened in the last couple of months, the reasons behind them is both internal as well as external. Now, on the external side, you've had geopolitical tension, you've had uncertainty about monetary policy, especially where the Fed is concerned, then the US elections, and of course, FIIs have been selling India, somewhat balanced by the domestic flows. On the internal front, I think the biggest factor for the market has been corporate earnings. So when you look at Q1 and Q2 of FY25, corporate earnings delivery has been muted in low single digit in terms of earnings growth. Now for FY25, the expectation is of mid single digit earnings growth, and FY26 about mid-teens kind of an earnings growth trajectory. When we look at the festive season, it got off to a somewhat muted start and then picked up towards the second half. The wedding season is now underway, and in terms of capex, government spending was absent in the first half, and the expectation is now that elections are over, monsoons are also behind us, we should start seeing some improvement in government capex. Therefore, the expectation for second half is that it will be better than the first half. Now, from a market construct perspective, when you look at valuations, the large caps, which is the Nifty, is trading at a slight premium to its long-term average history, while mid and small caps continue to trade at about 20 to 30% premium. Therefore, from a risk-reward perspective, we continue to believe that large caps are better placed as compared to mid and small caps.
But as we are approaching the festival season, the wedding season, any sectors that are looking good, or not just for the season, but also for the long term?
Yeah, so absolutely. When you look at the markets and the way the markets have corrected from the peak, the stocks have actually corrected far more than the market has. So before I answer your question on sectors, when you look at stocks, we are looking at it more bottom up. There are 3 key things that we are looking at. One, look at quality over momentum. Look at stocks where valuations are reasonable as compared to stocks where valuations are rich, and look at stocks with high liquidity or higher free float as compared to those which have lower free float. Now, from a thematic perspective or sector perspective on a structural basis, we continue to be positive on technology. We are starting to see signs of discretionary tech spend come back in large verticals such as banking, financial services in North America. We also have a large opportunity in terms of Gen AI adoption, where Indian IT services players are well placed.
Okay.
The second sector where risk reward seems to be favorable from a valuation perspective are the large banks. Here, multiples are below long-term average history. And of course, there are near-term headwinds. But what we believe is that in the last few years, we have seen improvement in terms of return ratios. These banks are well capitalized, and they don't need to come and raise capital. And the third segment, and what you alluded to in terms of festive season, what we are seeing is there is improvement in terms of rural demand. Urban demand, on the other hand, has slowed down. And therefore, we are trying to find sectors which are closely linked to improvement in terms of rural demand. For instance, the two-wheeler space, which also takes a lot of the offtake from the rural consumption side.
Oh. Lastly, your advice for the equity fund holders?
Yeah, absolutely. We've had a great run in equity markets over the last 3-4 years. What we are really telling our investors is don't look at return expectations based on only the last 3 years. moderate your return expectations, look at long-term trajectory for equity markets and base your return expectation on that. The second most important factor for equity markets is you have to stay disciplined. So therefore, stay disciplined in your approach to investments. SIPs, we've always said, is the best route. Look at asset allocation, look at your risk appetite, and look at your long-term investment horizon and goals. And therefore, approach equity markets in that respect. So what we are really saying is stay invested and stay disciplined.
Thank you so much, Shibani, for all the insights, for all the advices, and for your time. Thank you so much.
Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.